Hello, friends who have logged in to our webinar. The webinar is an introduction to options. I'm Stephen Reiter. I'm your presenter. We'll be starting in about 7 or 8 minutes. Well, maybe 5 or 6 or 7 minutes. So please stay tuned while we let all the people who have registered log in so they can join from the start. So just stay tuned. Thanks for joining. If you have questions, I'll be watching. You can type them in, and I will certainly do my best to answer any questions as we go along. Thanks very much. Hello, friends. Thanks for logging in to the webinar. An introduction to options will be starting in just a few minutes while we let others who have registered log in. My name is Stephen Reiter. I am your host and your presenter today. We'll be going through the basics of options trading, and we'll be using the AvaOptions web trading platform for examples and to help guide you, to help you understand how options are traded. So just a few minutes while we let others log in. We're going to keep the webinar down to about 40 or 45 minutes. I am watching for questions. Feel free to ask questions, and I will do my best to answer along the way. Thanks very much. We'll get started in just about 3 minutes. Thank you. Hello, everyone. Thanks for joining our webinar. Our topic today is an introduction to options. I'm your host, Stephen Reiter. We'll be talking about options from the very basics, about what is an option and how do you trade an option and what drives the valuation of an option. We're going to get started in just another minute or so as people are logging in at a pretty good pace. So just bear with me for another minute and then we will get started. Thank you. All right, thanks everybody for waiting. We're going to get started with the webinar. My name is Stephen Reiter. I'm your host. I'm also the main driver of this options trading platform of the AvaOptions business with AvaTrade. We're going to talk about options from the very basics. What is an option? What drives the valuation of an option? Why would you use them and how do you trade them? So thanks for joining. People are still logging in, but just so you know, we are recording this webinar. It will be available sometime tomorrow, I believe, on the AvaTrade YouTube channels, so you can look for it there. So I'm going to go back and forth between a PowerPoint presentation and the AvaOptions web trader, which is a unique interface which really will help you understand options. I am watching for questions, which I will answer throughout, and as I mentioned earlier, we'll keep this webinar down to about 40 minutes. So what is an option? Well, before we talk about an option, let's go to the underlying trade. What is an FX or a CFD trade? A CFD being contract for differences. These are the basic assets that you're trading with AvaTrade and with other online margin trading brokers. An FX trade or a CFD is a contract where the trader buys or sells a specific amount of currency or asset at a specific rate. 100% upside, 100% downside until you hit your stop loss or until you have a margin call. Let's put it in a picture. This is a typical profit and loss diagram. Along the x-axis, I have the Eurodollar rate. So this just imagine this is Eurodollar that we're going to trade. So in the middle, you have the current rate. As the market goes up, if you've bought Eurodollar, the market goes up, you'll have profits as shown by the thicker blue line. And as the market goes down, you'll have losses. It's symmetric. You have profits on the upside, losses on the downside, and you'll also have overnight interest costs. That is the basic trade that until now, many of you have been trading. So what's an option then? An option is a contract that gives you the right, but not the obligation, to buy that same asset at a specific price on a specific date. Let's look at it in terms of a picture. We have the call option in black. A call option gives you the right to buy Eurodollar, but not the obligation. In the middle, if we set the strike, remember I said you have the right to buy the asset at a specific price. That specific price is called the strike price. If I have the right to buy Eurodollar at the current market price, which is in the center, if the market goes up, I would exercise that right because the market's gone higher. The market's gone from, let's say, 105, where I have a strike, to 110. So I'll exercise my right to buy at 105. I'll sell in the market at 110, and I'll have a five-point profit. However, if the market is below 105, I would never want to buy at 105 at the strike. So I would simply walk away and let that option expire worthless. That's why on the downside, we have a horizontal line showing that you have no further losses beyond the cost of the option that you paid up front. The cost of an option is called the premium. So you can see in this diagram, the blue line, which is the symmetric forward trade or a spot trade, has symmetric risk up and down, and the trade-off of the call option is that you have to pay an upfront premium for the right to buy in the future at the strike price. And if you just look at the diagram and look at the relationship between the black call line and the blue forward line, there's a trade-off. The cost of an option is very simply a cost. If the market is unchanged over the life of the option, you're going to lose that option premium. However, if the market goes up, you're going to have profits. If the market goes down, you will not lose more than the premium paid up front. So there's a balance and there's a risk and reward profile of an option that has to make economic sense and mathematical sense, and that's what we're going to talk about next. Again, welcome everybody. For those who joined late, my name is Stephen Reiter. We're talking about options and options trading from the very basics. Here's an example of a call option with some numbers. This was written a few months ago when Eurodollar was trading at 115. Now it's trading at 105. So this was a call option with a strike at 115. The option cost 60 pips or 0.006, which meant your break even was 115.60, right? You're paying 60 pips up front, 0.006. If the market goes up to 115.60, you can exercise your right to buy at 115, sell in the market at 115.60, realizing your 60 pips profit. And let me just get my tools to write on this up, if I can figure this out. Here we go. That's the laser pointer pen tool. Here we go, pen. Where are we? I can't figure this thing out. Pen, 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 pen. Highlighter. No. Highlighter, pen, pen. Here we go. I exercise my right to buy at 115. I sell into the market at 115.60, realizing a 60 pip profit, which covers the cost of the option, which was 60 pips. So that's why this is called my break-even point. If the market continues to move higher, I have unlimited profit potential. If the market goes lower, the most I can lose again is the cost of the option, which was 60 pips. In the case of the forward trade or a spot trade, I start to make money, I start to profit immediately as the market moves higher and lose as the market goes lower. The other type of an option is a put option. The put option gives you the right to sell at a specific price in the future. So when you're buying a put option, you're taking the view or you're protecting against the market going lower. If I have a put, the market's trading again at 115 here, and I buy a put struck at 115 and the market drops to 114 over here, then I exercise my right to sell at 115. I can buy it back in the market at 114, earning 100 pips or 1 point of profit. Against that profit, I have the cost of the option, which in the example of a call was 60 pips. So I would be left with my 40 pips net profit. And of course, as the market continues to go lower, I can have even more profits. So that's a put option. Now, for every option, it's a contract between two players or two market participants, a buyer and a seller. With AvaOptions in the AvaTrade platform, you have the right to buy or sell options. You can be the option buyer, or you can be the option seller, which is also called the option Reiter, which happens to be my last name, spelled differently. Just a coincidence, really. So if you sell an option, your P&L is going to look like this. So selling a call, if you short a call, if the market moves higher, you're going to start to lose money, right? Because you're being the insurance company. You're protecting somebody else against the market going higher. So as the market goes higher, you'll start to lose money. However, if the market remains unchanged, or if it heads lower, this option will finish out of the money. It will expire worthless, and you, as the options writer or the option seller, will keep this premium as a profit. And this is one of the most powerful reasons that people use options, is to sell options, to be the insurance company, to get paid for taking risk and for writing options. We'll talk more about that theme in a few minutes. Again, I am watching for questions. If anybody wants to type in, feel free. Here's selling a put option. Selling a put option means you are giving someone else protection against the market going lower. So that's similar from a risk perspective to going long the market, right? If you go long the market, or if you buy the asset, if the market falls, you lose. If you write a put and the market falls, you lose. However, you're always going to keep that premium if you hold that position to expiration. So even if the market falls, the put has an advantage because you've earned premium. Yes, you're going to lose money as the market falls, but you've earned premium, so you're losing less than the forward, or than just simply buying spot. So we have now 4 types of trades: buying and selling, calls and puts. And then we can combine different calls and puts, different strikes, to create any desired payoff. And we're going to show that to you in the trading platform in a few minutes. So let's just review some definitions. A call option gives you the right to buy a specific amount of an instrument at a specific price and date. A put option gives you the right to sell. Premium is the price of the option, or the cost of the option. Strike is the price at which you have the right to buy or sell. That's the exercise price, or the strike. And the expiration date, or expiry date, is the date and time on which you have that right to exercise. There are 2 types of vanilla options. There are European style options and there are American style options. European style options can only be exercised on the expiration date. American style options can be exercised on any day. The standard product in the foreign exchange market, in the gold market, in index options and others, the standard product is European style options. Now, that doesn't mean you have to hold a position to expiration. It means that you can only exercise at expiration. So if I buy a call option, I can always sell it back into the market. I can buy it for a week and sell it after 1 minute, which is not advisable unless the market has a big move, because you do have bid-ask spreads, which you'll see soon. But basically, European style options can be bought and sold any day, all the way up to expiration. And American style options can be bought and sold as well, but they can also be exercised on any day. American style options are mainly used in individual stock options, which we do not offer in our platform. Our options are traded over the counter. They are not exchange traded options, even though they may be identical economically to an exchange traded options. This is margin trading. Every client or every customer account with AvaTrade is facing AvaTrade as their counterparty. AvaTrade then manages its risk, hedges its risk with various banks and exchanges as well, but your counterparty is AvaTrade in all cases, in whichever jurisdiction you're opening your account. So these are not exchange-traded options. These are over-the-counter options. Again, they may be economically identical, but your counterparty is AvaTrade. So what determines the price of an option? I'm going to use a fairly simple picture that most of you will understand to help you conceptualize what's driving the price of an option. Okay, the price of an option is very simply the present value of the expected payout of an option. Okay, I'll say that again. It's the present value of the expected payout of an option. Now let's use this picture as an example. I've got a diagram here. Some of you may have seen a pachinko machine or this machine, which is kind of a bed of nails on a wall with a bunch of cups underneath it, or channels to catch these balls, is called a kinkunks. And I've never learned if that's the right pronunciation, or a bean machine, which was created by a very bright guy named Sir Francis Galton a few hundred years ago to demonstrate the central limit theorem, which underlies options valuation. At the top of this picture in blue, we've got basically a reservoir of balls. Let's say these are all little marbles up top here. And we're going to drop these balls right on the central nail at the top of this lattice. And when that ball hits this nail, it's going to bounce right or left. It's got a 50-50 chance, because it's striking at dead center. It's got a 50-50 chance of bouncing right or bouncing left. So it hits one nail, it'll bounce to the right. Then it hits another nail, again, 50-50 chance, it'll bounce right or bounce left, bounce right, bounce left. And every ball is going to find its way down into one of these channels. And after all of these balls, let's say there are 1,000 balls or beans that are getting dropped through, we're going to end up with a whole bunch of balls in the center and others on the sides. So let's have a look and see what happens. When we do that, this is our result every time. No matter how many times we drop 1,000 balls through the top onto that central nail, we will end up with this sort of distribution of results. Why is that? Because the chance of a nail getting to the outside bucket is very small. In order to get to the outside, he has to bounce to the right, and the right again, 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 and the right again. And since there's a 50-50 chance at every time, the chance of getting to this outside bucket is 0.5 times 0.5 times 0.5 times 0.5 times 0.5, etc. So this is going to give us this distribution. And what does this distribution look like? It looks like this normal distribution. Every time we run this exercise, we're going to end up with this sort of a distribution. And it's the same thing with the markets. Today's price of an asset reflects all known future events. Today's price of an asset is the gross knowledge or opinion of the market, where the number of buyers equals the number of sellers at that price. So we already have all the information in the market. From here going forward, we say from a trading perspective that it's a random walk. The market might go higher, might go lower, we don't know. So we can say the same thing, just like you have in this picture. We can say the same thing about the assets that we're going to trade. Why is this relevant for options trading? It's very simple. If we're going to buy an option, we want to know what's the chance of a payout. If I buy an option that's struck at the money right here, right? If I buy euros trading at 105 and I buy a call struck at 105, then I have all of this area of potential profit. So if I take the area underneath this normal distribution line, that's going to give me my expected payout, the expected payout of the option, which means there's some probability of moving up to, let's say, 106. There's some smaller probability of dropping to 105.50. And there's some other probability of being above 105, etc. So if we take the profit at each point along this curve times the probability of being at that rate, that's going to give us the area under the curve. That's going to give you the value of an option. I'll just explain a little bit further on the next page. Suppose we have more nails. More nails, a taller lattice, means we have more time, right? More time, more nails, the nails can go further. What happens if we drop these nails down? Instead of dropping through whatever, this is 10 nails, 10 levels, we have 15 levels, then there's more of a chance to go further out to the right or to the left. So comparing these two distributions, more nails or more time means we have a wider distribution of future prices or a wider distribution of future outcomes, and therefore the option to buy at whatever this price is worth more in the blue scenario than it is in the red scenario. Let's put it in terms that you use every day. Insurance. You're buying insurance on your car. You're buying insurance on your car, and you can buy insurance for 6 months or for a year. Well, options for a year cost more. Why? Because the probability of you having an accident in 1 year is higher than the probability of having an accident in 6 months. Same thing with options. A 1-year option costs more than a 6-month option. What else could drive the probability of a payout? What else can drive the insurance company to charge more? Volatility. Volatility. If you're a crazy driver, if you're a young man driving, insurance will be more expensive than an experienced woman, let's say, because statistically speaking, and that's all that matters is statistics, not opinion, statistics say that an experienced female driver is less risky than a young male driver. Or let's just take age out of it, a male versus a female driver, an older driver versus a younger driver. Less risk, less probability of a payout, the option or the insurance costs less. I'm being asked by Patrick, why do we need to trade Forex options if we can trade Forex directly using a leveraged account? Well, I'm just going to skip back real quick to this picture. This is the reason right here. Leverage is not enough. An option protects you against downside, and you can use a stop loss when trading FX, but if you use a stop loss, as soon as you hit that stop loss, you're out of the trade. Whereas an option, if the market starts here in the center, then it moves up, and then it moves back down again, and then it moves up again, and then it moves down again, and then it finishes up, the options trader is still winning in the trade, whereas the spot trader got stopped out and lost his money down at the bottom. That's one reason. And the main reason is this one, the right to sell an option. If you sell an option, you're going to earn income. There's no way to replicate selling options with trading Forex or trading spot. Okay, let me go back to where I was. More time, more volatility, more nails gives you a wider distribution, gives you a greater value to an option. Now, I spoke about buying an option at the money in our original examples. We can also buy options out of the money. Buying an option at the current market, which in Eurodollar, let's say is 105, is going to cost some amount. You see here in the under the black. If I have the right to buy at 107, it's going to be cheaper. Why? Because the option will only have a payout above 107. And as we saw here, 107, let's say, is at this level. The amount of profit or the probability of a payout is much smaller than at 105, which is in the center. So that drives the price of an option. Where is the strike? That's one determinant of an option. We spoke just now about volatility, the probability or the riskiness of the asset, the riskiness of a driver, the riskiness of an asset. For example, an option on gold will be more expensive than an option on Eurodollar. An option on Eurodollar will be more expensive than an option on Euro Swiss. Okay? And this is kind of putting it all together, looking at the volatility and where is your strike. Those are the things that drive the price of an option. How volatile, how much time, and where is the strike. Those are the three determinants of the option value. Strike, closer strike is more expensive. Time, more time is more expensive. Volatility, more volatility is more expensive. Now let's look at some examples. We're going to go into the trading platform right now. Let's go to the trading platform. This is the AvaOptions web trader. We have both a web trader and a mobile app, which has the same look and feel. They're both excellent platforms. I can say that because I designed them. But the main point is that we offer amazing and unique and patented interactivity that helps you understand an option. Let's go back to our favorite Eurodollar. On the left side, we have our assets, Eurodollar, cable, Kiwi, we've got equity indices, we've got crosses, we've got emerging markets. Let's just choose Eurodollar by clicking on it. This is a chart of Eurodollar. Let's go with spot trading. So you can use this platform to trade spot, meaning just trading FX. This is a chart showing hourly. Let's look at 5-minute candles. So this is simply a chart of Eurodollar in the last using 5-minute candles. On the right side, we have a profit and loss diagram. I'm going to click here where it says price. I'll show you the profit and loss in dollars, and this is a dollar account. So I'm going to set my amount at 100,000. That's up here, the quantity. You can type a quantity in lots. You can use your mouse. You can do whatever you want. 100,000 Eurodollar. If the market goes up, I'm going to profit. If the market goes down, I'm going to lose. If I go short the market, if the market goes up, I'm going to have losses because I'm going short the market. If the market goes down, I'll have profits. I can see my P&L various ways. I can see it in dollars. I can see it in euros. I can see it in price. Right? So if the market goes from 105.20 to 105.50, that's moving up 25 pips. You can see that right here. And if I put my P&L in dollars, I'll make $250. I can put in limits on that trade by clicking the word limit. I can add a take profit, and I can add a stop loss. I'm just trading FX here, not an option. But it's very visual and easy to understand. I can double click and type in my exact level. I want to put in a take profit at 105.50, good till canceled, good for the week, good until the end of the day, apply. So if I exercise this trade, if the market hits 105.50, I'm going to sell, I'll make $220 profit. I click buy, it tells me how much margin is available, how much margin is needed for this trade. Because of other positions, this will reduce my required margin. Cost of the trade, this is daily interest cost or carry or swap fees, whatever you want to call it. And it shows us the bid offer spread, which is $8 because it's a 0.8 pip bid ask spread. I click execute, it's done. And immediately in our bottom panel, you can see the trade came in right here, Eurodollar. We bought 100,000 Eurodollar at 105.28, and we have both a take profit and a stop loss in blue. Those are pending. Now that's just trading spot. Instead of that, let's look at trading an option. I'm going to go back here to Eurodollar, close the limit panel, and click where it says spot. That's our strategy button. Let's choose a call option. That's what we're here for, isn't it? When I click a call option, I have some extra tools. I can choose my expiration date by clicking here. The default was 1 week. Let's say we're going to do a 1 month option. Apply. This chart is showing me 1 month of history in the chart. It's showing us 2 standard deviations of potential movement. This white dot at the bottom and white dot at the top is showing us a 95% probability range. We're 95% confident that the market is going to fall between these 2 dots at expiration. And we're 67% confident that we're going to be between this inside parabola, the lighter gray. So that's framing the risk for us. So if I buy a call option at the money at 105.50, it's going to cost me 120 pips, 121 pips. I can sell it for 115 pips. If I move my strike higher, the option gets cheaper because we said an out of the money option has a smaller chance of finishing in the money, and therefore it's much cheaper. That's only going to cost me 10 pips. For a 110 strike is going to cost me 12 pips. So at the money, 105.50 is costing 120 pips. Go all the way out to 110, the price drops all the way to 11 pips. And you see it in the diagram. A deep in the money option costs a lot because it's already in the money. It already has intrinsic value. Very interactive and intuitive. I can sell an option, and I see this. If I sell a call option and the market drops, I keep my premium. If the market moves higher, I'm going to head into the loss territory. The orange line is showing us the P&L today. If I buy this option and immediately turn around and sell it, the orange line is telling us our P&L. So if I buy and sell today, I'm only going to suffer some bid-ask spread. Over time, I move my horizon line out to expiration, we get to the red and green. We reach expiration. So over time, the option value, we call this decay, option decay, the time value disappears and we reach the expiration values. Instead of a call, I can trade a put. A put profits if the market goes down. I can sell a put. Selling a put, you profit if the market doesn't go down. Click on the strategy button. You can see different strategies like strangles and straddles and butterflies. If you don't know what they are, click this guide button, toggle over to guide, and you say, wow, what's a strangle? And it explains to you what a strangle is. A strangle is selling both a call and a put at different strikes. Risk is unlimited if you sell a strangle. If I buy a strangle, then my profit potential is unlimited. My cost is known. I'm buying two options. Try it. Click the word try it. Here's a strangle. Let's change the expiration. Let's do a 2-month. A 2-month option. We now have 2 months of history and we have 2 strikes, and I can set the strikes wherever I want. If I buy a call and a put, I'm paying for 2 options. It's going to be expensive because I don't know where the market's going. I just think it's going. It's going to move. It's going to end up higher or lower. I don't know which way it's going to go, so I'm going to buy them both. More interesting, I think, is to sell a strangle, because you're selling 2 options when you think the market is not going to move much. You think it's going to be range bound. We're trading right now at 105.20, and you think, you know what? It's not going to finish below 104. I think it's not going to move much higher than 110. So I'm going to sell both a 104 put and a 110 call. It shows you the premium I'm going to earn is 100 pips for the put, 25 pips for the call, 128 pips total. So my break even is going to be 128 pips, which is the amount of premium I'm collecting, higher than 110. So my break even on the upside is going to be 111.28, and on the downside is going to be 104 minus the premium I took in. So I have a much bigger spread of profitability, all of that green. But today I have risk. If the market moves up or down, I'll start to lose money or profit right away. Over time, look at this horizon button, you earn time decay and you get to that final juicy payout where both options expire out of the money, hopefully, and you keep all of that premium. You like it, click sell. It tells you how much margin you need, etc. Execute, boom. And then very quickly, it'll show up in our open positions. There they are. I sold a put and I sold a call. I have my history. I can see the trades that we just did. We sold puts, we sold calls. We also put limit orders on the spot trade that we did. And I can also close trades, of course, and then go into close trades. It'll show me every trade that I've closed. And by the way, this nifty platform lets you open up new windows. I can pop this out. I think you can see this. I can pop out that open positions screen into another page. I can also look at my risk manager. The risk manager is showing me all of my net risk. It's showing me the combined risk of all of my positions broken down by currency pair, showing me my total delta, how much is coming from cash, how much is coming from options. We'll have that in another class when we talk about what is delta. You've got your account net liquidation value, that's your equity, how much is in cash, what it would cost to close out all of your options positions is your net option net option premium value, and your unrealized spot P&L for your total account value. If I close that, it'll pop right back in at the bottom. Same thing, it's responsive. You can open and close, and you can do this on a smaller screen. It's a very fully featured platform, which I recommend watching some other webinars to really understand to really understand what's going on and learn all the different features. We've got amazing charting capabilities, for example. You can put in, let's just put in something like a moving average. Let's choose a simple moving average and exponential moving average or a weighted moving average. Let's go with this, the simple moving average over 14 days. I can change my colors, make them bigger, apply. So that might help you determine where you want to set your strikes. You also have more fun things like Bollinger Bands, all the cute stuff. You can also go here to a screenshot and automatically save the trade and share it with your friends. You also, when you go, let's say you like this trade, you click sell, and you want to share it with your friends, click the sharing button. When you click the sharing button, it creates a link. You can copy that link here, stick it in an email, or you can put it in your WhatsApp or Facebook or Twitter, share it with your friends. They can click that link and automatically see the exact same trade in their platform ready to execute, which is a really nice way to build up a community and show off your talents. Okay. One other type of a trade, for example, let's look at a risk reversal. A risk reversal is buying a call and selling a put, or the opposite. Okay, when I do this, I can do a zero cost trade. Like this, zero cost, I'm going to buy a put and I'm going to pay for it by selling a call. So basically, if I'm very confident the market's not going higher again, then I don't really worry about the risk as the market moves higher, and I'm getting this put option for free. My net premium is zero. I'm buying a call, selling a put at different strikes. Very common trade. It's often called a collar, or it's more commonly called a risk reversal. If you already have a position and you're hedging your risk with this strategy, it would be called a collar. If you're simply trying to exchange a call for a put, so you don't have to pay anything up front, then that's called a risk reversal. I'm being asked if we can customize strategies. Well, we have standardized strategies in here. For example, a butterfly. A butterfly involves a call and a put at one strike. And then let's say if you're buying the butterfly or an iron butterfly, if I buy the call and put in the center, I can set the strike wherever I want. And then I'm going to sell a call and sell a put to help pay for it, to offset some of the cost. If I just do a straddle, it's going to be very expensive. That's a straddle. It's going to cost me 338 pips. But if I sell some of that upside, it's going to be cheaper. That's called a butterfly. So instead of 338 pips, a similar trade is going to cost me 200 pips or 280 pips. And of course, I can also go short it. And you can move these strikes around wherever you want and create some customized strategy. We have seagulls with 2 puts and a call, and seagulls with 2 calls and a put. We call that a seagull. Not everybody does. But again, you can drag your strikes around wherever you want. And of course, you can combine trades, just executing them separately. The advantage of executing trades in one screen like this through the strategy button is that you get some benefit of bid-ask spreads. We reduce the bid-ask spread on trades where there's a long and a call, a long and a short. So for example, a call spread is going to be cheaper to execute than separately buying a call and selling a call. Here's a call spread, and then as time decays, you see what happens. I'm getting ahead of the beginner class in some of this, but I really want to show you some of our features. One other thing you can see in the strategy menu is an implied volatility chart. Implied volatility chart is going to show you where implied volatilities have been for whatever time period. Here's looking at the last 6 months of implied volatility for Aussie dollar 1 month at the money options. You can see volatility has been moving higher and higher. We can add to that anything we want. We can do an option on Eurodollar. Let's look at 1 month Eurodollar options. Aussie's more expensive. Aussie options are more expensive. Let's add gold, even more expensive. I can just type it in, XAU, there it is. Gold options, even more expensive. This is an amazing tool. This information is next to impossible to come by. Look at 1 year of history. You can see basically that the war going on in Ukraine is what drove the volatility much higher in March. And you can see that last year was pretty quiet. If you look back over the last 3 years, You can see we had another spike back here. That was the beginning of COVID, big spike. And that eventually faded. And now volatility is higher again because of the risks of contagion and whatever else is going on in the world. You get a better picture looking at 3 months. You can see that vols really are well off their peaks. You can also look at risk reversals, basically any of the strategies that we looked at. So for example, instead of looking at delta neutral, we can look at a 25 delta put. So this is the volatility of an out of the money put, and here's the at the money put. So out of the money options cost more than at the money options. And I can look at risk reversals. Again, this is we're getting to advanced stuff here. Looks like that. If you want to trade this risk reversal, once you know what it is, you just click here and say trade the Aussie dollar 10 delta risk reversal, and it automatically populates this page with a risk reversal trade, buying a call, selling a put, each of them at roughly a 10 delta strike. Cool stuff. I got a little bit advanced there, but I like the platform. So that's really what options are all about. Let me go back to the presentation for a minute, kind of reviewing why do you care about options. First of all, options let you fully express your market view. It's not simply buy or sell, right? You've now got buy if, or I think the market's going higher, but I'm not sure. Or I think the market's going to be stable. Let me sell options to earn premium. So options let you balance risk and reward. It's not simply buy or sell with a take profit or stop loss. It's much more interesting. It involves probability, it involves time, it involves risk. Options let you trade with less emotional stress. If you buy a call, you can go to sleep at night because you know the most you can lose is what you paid for the option. If you trade spot and you simply buy the asset like Eurodollar, you could wake up the next morning and find that your account has been stopped out because Eurodollar fell a lot and you got stopped out. So options let you trade with less emotional stress, sleep better at night, and that's always a good thing. You can have unlimited gains with limited risk. If you buy an option, you know what your worst case is and you can have unlimited upside. And by selling options, you have new ways to earn income. And net options traders have more fun. Why with AvaOptions? I believe it's the best platform for trading options, honestly. European, not binary options. We don't trade binary options here. You have more than a dozen option strategies with price improvements for spreads. We've integrated auto chartists, which I need to show you really quickly. In the EU, options trading enjoys much more leverage. If you're a retail trader in the EU or in the UAE, you are limited, in Australia, you are limited to 30-to-1 leverage, roughly. With options, we give you 100-to-1 leverage. Increased leverage available. Risk management tools, social trading, as I said, share your trade, chat, partials, lots of stuff. Let's go back to the platform. I mentioned auto chartist. I click this, see Aussie dollar, there's the orange 6 next to the auto chartist icon. There are 6 automated pattern recognition signals showing that in most of them, according to a 15-minute chart, there's a bearish signal on Aussie dollar according to the chart. This is what it looks like. It was identified where this blue line is, saying the market is going to continue to go lower, and it has. If you like this or agree with this idea, you click trade, and it sets it up automatically. Some of the strategies will have stop losses, and for example, this suggestion from all perfectly automated chart recognition has a stop loss set at 0.70276. You click trade, there it is. It's set up to sell with a stop loss at 0.70276 using the same chart that was identified. That's auto chartist. If I click on the side menus, you can see other tools that you can use. You can look at your account to see all of your accounts with AvaTrade and see their balances, and you can do transfers between accounts, etc. You have deposits. You can upload documents if you need to upload a utility bill or some sort of an ID. After you've opened your account, you can do it all here through the web trader or through the app. You can withdraw funds. We have video tutorials. We have the economic calendar, so you can see what events are coming up that could impact the market. So if I click video tutorials, you can cycle through various here's a list. We've got all these different videos to watch. These are various webinars and other tutorials that we've created. You just click it and you can watch it right here within, let's just kill that. You can watch it right here within the platform. Okay, I'm going to kill that. Let's go back to trading. I'm being asked, any plans to add indices, metals, and options? Metals we already trade. You can trade options on gold and silver. Here's gold. Put spread in gold, ready to go. We also trade options on silver. We will very soon offer options on the S&P 500. I hope that they'll be live by the end of this month. And once that's running smoothly, we're going to add other indices and crude oil, and then hopefully other assets. So we are absolutely working hard on adding more assets. You can trade the assets themselves. You can trade the NASDAQ, for example, but options are not yet available. They will be available very soon. It's a top priority. Okay, and as I mentioned, all of the functionality here is also available in the mobile app. The mobile app is, of course, available for both Android and iOS. It's a beautiful app, I must say, and very kind of easy and fun to use, but really has all the same look and feel as the web trader, including this implied volatility charting, which is not available, of course, in the indices yet. Implied volatility charting and other neat tools that you'll only find here. Okay, so I'm going to end the webinar now because I said we would limit it to 40 minutes. This webinar is going to be uploaded, as I mentioned, to the YouTube channel, AvaTrade. Go to AvaOptions playlist or just go and search for AvaOptions in YouTube and you will find our playlist. You'll find all the webinars and you can, I really recommend that you try both the app and the web trader. You can open a demo account, real accounts. It's easy to use, and once again, it's not only for trading options, you trade spot as well. I just think the way we integrated and use limit orders is just so nifty that anybody can use it. You can have an entry limit order. So here I'm saying I want to buy Kiwi at 62, and I'll put in a take profit at 62.50, sorry, 66.50. And I'll put in a stop loss at 59. All set up, ready to go. So this is a pending order with a contingent take profit and stop loss, as it's shown here. Execute, and it's done. And there it is in your open positions. It's all in blue because it's pending. It hasn't been opened. It's a pending buy with a contingent take profit and stop loss. So if it gets filled, the top line will go into white, and the blues will continue. So thanks again. I appreciate your participation, and I look forward to seeing you trading and getting involved. We have chat right here integrated in the app, so you can come in and very often find us and leave questions and things like that. Okay, we're ready to go. So thanks very much. See you soon. Have a great day. Oh, one last thing I always forget to mention, nothing I said is advice. We're just teaching you how to use the platform and teaching you what are options, but we don't give advice. It's up to you to decide and to investigate and to decide what you want to trade, how you want to trade it. We're giving you, I think, the best tools in the business to do so. Thanks again. Have a great day. See you next time.